All right, welcome everyone. Thank you for joining us for another installment of these Lunch and Learn webinars. Today's topic is about fraud detection and specifically how to apply some, I should have used the word practical. They're practical statistics to detect both deceitful and systemic fraud. So right off the bat, let's try and get some common understanding. What do I mean by deceitful and systemic? So deceitful, I think, is easy to understand. It means the fraud or the sort of the thing that was illegal or wrong was done purposely. So someone actually tried to do something that was purposely and intentionally deceitful. Okay. Systemic is a little different, and I'll try and explain through an example. Systemic fraud means the people aren't doing anything weird or wrong in terms of being deceitful. They're not trying to purposely manipulate the system. But because of how the system is set up, they're finding ways around it. So they're not benefiting it from a personal perspective, but they're trying to take advantage of the system. Okay. So those are the two categories that I want you to keep in mind as you see some of the slides. One is about being deceitful and the other one is more about the systems. All right. Well, I don't want to bore, obviously, a lot of people with unnecessary statistics. Somebody try and come in? Oh, go ahead, Angelo. Yeah, go ahead.
Sorry, Carmen, when we're talking about the fraud, are we talking about fraud, obviously, the typical one where there's a financial benefit, personal benefit, but are we also talking about fraud of someone may be faking numbers, faking data?
Yeah, okay. Exactly. So they're both, right? Because you have those. That's a good question, Angelo. You can have purposely manipulating numbers, not because you're actually getting more money in your bank account, but you're trying to maybe fake numbers for the industry or for the market, right? Those would still be deceitful. You're still purposely doing that. Good question, Angelo. So before I get into this tool, I wanted to just back up a little bit and take something that people generally understand through simple examples. So if you look at the top right graph, the one that just has these bars with 1 to 6. So this would be an example if you rolled a one die, not a pair of dice, but one die, which has an equal probability of getting anywhere from a 1 to 6. So it won't be exactly the same because there's random variation, but you would expect more or less number 1, 2, 3, 4, 5, and 6 to have the same level of output, more or less, okay? So that's an example of an outcome that you say, well, because I'm rolling a dice or we're only rolling one die, it has 1 to 6. I expect it to be more or less 1/6 probability for all of the numbers. Then we could look at another example. Let's say you have heights of a group of people. This could be a group of people that could be a city, a country, a population, whatever the case may be. In this case, you would expect maybe something that was more normally distributed. So that would be the bottom right curve. You would expect something that resembles that red overlay that you see here with a little bit of randomness, of course. But you would expect something that has an average, more or less centered with some outliers on both sides, both on the short side and on the tall side. But it would generally look like a normal distribution. So these are things that generally people understand and can comprehend very, very easily. So then the segue here is, what about if you have other data sets? What about if we're not dealing with dice or cards or heights? What if we were looking at something as simple as street addresses? What's interesting is intuitively you might think, well, it follows the same thing. I would expect it to be completely random. But that's not the case, okay? If you think of the first value of a street address being 1, so let's say your address is 673, so your first number would be the 6. The question here is, do you think the first value of an address, number 1, occurs the same number of times as number 9? The reality is no. Okay, the numbers actually go down in that logarithmic fashion where 1 shows up a lot, 2 a lot less, and it keeps going down, down, down until you get to the number 9. Okay, so in fact, approximately 30% of the numbers start with the 1, while only less than 5% start with the 9. If you're trying to understand why that is, just think of it intuitively with a street, right? If you look at your neighborhood, wherever you live, and you have a whole bunch of street numbers, they may start at 100, they may go all the way to 643 or 1,478. So the number one will show up a lot because no matter how few houses you have, the number one will come up tremendously, right? But if you're all the way on the 9, they tend to have less and less occurrences of those numbers. So this is an example where even if you wanted to understand street addresses, you have to understand what model or what distribution you should be using. It is not, for instance, something that is flat or something that is normal. It's something that looks like this, where the curve flows downwards, okay? So this one here specifically is called Benford's first digit law. It actually is something that was found and identified and recognized many years ago about how first digits sometimes vary in things that are as simple as addresses and even phone numbers. So what you see on the bottom right is actually if you wanted to use this for your own work, you can see what the expected outcome is from 1 to 9. So you would expect the number 1 to show up 30 times as a first digit, but the number 9 only shows up less than 5% of the time as a first digit. Okay, so now we have another segue. So we say, so what? So that's all very cute and nice. I have this weird distribution from 1 to 9 for first digits. Well, the so what here is that you can apply this to other data sets like invoices, expenses, and prices. And this is where we start getting into the topic of this webinar, which is trying to find fraudulent activity, okay, by following some of these tendencies. All right, so a little bit of theory here. So this is sometimes called, if you're going to look it up yourself and Google it, it's often called digit analysis. So it's often referred to as a new weapon in what auditors can use. Auditors have a lot of different tools and kits in their sort of tool bag, especially if you think of accounting auditors or financial ones. They have many different ways to try and find out the authenticity of numbers. Okay. And as was asked earlier in the webinar, you could apply this to different types of information like transactions, income statements, stock market movements. It's to find out if there's something bizarre or weird going on that is not expected. Okay, so there are standard techniques for forensic accounting, which is another term used for this topic, in order to spot possible manipulation. Right? Is someone doing something purposely with the data? So this includes things like fake invoices, manipulation of orders to stay within spending limits. There's a lot of different categories when you're trying to understand manipulation of data. So Benford's law is just one of them, and I'm going to show you a couple of different examples. So this one says the first digits in any list of numbers that have not been generated by some systemic process follow a logarithmic rather than a uniform pattern. Okay, so that's the law that we're going to take a look at in a couple of seconds. But there are other distributions as well, and I'm going to show you a couple as well. So first, second, last, before the decimal, after the decimal. Each one has its own special type of distribution. And once you know that, you can have a lot of different interesting investigations and conclusions associated with that. Is there a question that I should be answering right away?
Yeah, it should be.
Yeah, if you can click it, please. Thank you. So what in first digit analysis, is there a study or data that demonstrates that fraud occurs with certain digits versus others? Not really. I'm going to show you a couple of examples, Abdel, on how this works. There are a few that sometimes come up more than others. So for instance, if you have certain tendencies, like because you're adding taxes to a certain number, the fact that you're adding always a certain tax ratio to a certain number sometimes generates a number more than others. So that does happen. But in general, like a lot of things that we do in operational improvement or continuous improvement, the tools we use, I always, if those of you who attended my webinars before, I consider them flashlights. My tool is a flashlight. So the tool is saying, I see something weird and I'm pointing the flashlight to this set of numbers. I don't know why yet, but it is telling me something bizarre is happening. Okay, good question. So here's a real example. It's an actual case study of a client that we had that needed this type of investigation. So what are we looking at? We're looking at first digits. So let me be clear what this means. If you had an invoice or a PO for $473.12, so then the first digit is a 473, right? So this is an actual distribution of first digits of all invoices that were received And what you do is you superimpose it on that graph. So what you have there is the red bars is the actual data from the client, and the green line is what should be expected from Benford's analysis. So what you see here is it follows pretty close, right? There's a few minor deviations. The 4 column is a little smaller than the green line, and the 5 column is a little higher. The red column, sorry, for number 5 is a little higher than the green line. But when you do the analysis and you're looking for significance, it's not significant. So even though there's a little variation, it's not enough to say that something interesting or bizarre is happening. So in this case, it would pass, right? It would say check mark. You don't have a problem or perceived problem, any significant manipulation of invoices or information. Here's another actual case study. It's a different looking graph. It's a smaller set of data, but I wanted to show you that it doesn't always follow perfectly. So here you have the red squares is the expected Benford distribution from 30% all the way to 5. And the blue circles is the summary of a company's invoices. So here's an example where there's something maybe interesting coming up. The number 1 shows up a lot higher than expected. We expected to show up only 30%, but it was showing up closer to 45%. And on the downside, we have 3s, 4s, and 6s that are a little less than expected. The explanation here was not fraudulent. It was quite simple. Because this was associated with a company, not a large company's invoices, many of the invoices tended to be with the 10,000 range, right? The 10,000, 15,000, 20,000, not 20, but up to 19,000. So it just meant that this company had most of its invoices in that sweet spot of $10,000 to $20,000 per invoice. So of course it meant that the number 1 showed up a lot more than expected in a perfect Benford analysis. But it allowed a discussion to see, is there something fraudulent happening, both purposely or systemic? Here's another example. So this is a different, slightly different distribution, okay? It's a second digit. So my example of a 473. So now you're looking at the 7s. It's still, the number still goes down. The expectation still goes down. But if you notice, if you compare with the first graph where it drops significantly, more logarithmic, this one is a slow drop. That's the theory of the second digit, okay? But now we're starting to see something that actually showed up as being significant. The number 0 and the number 7 showed up a little higher than expected, and to the point that it was significant. So there was a much higher incidence of 0s and 7s. This slide just shows a little bit of a summary, so I'm not going to go through all the details of how we got to this conclusion. But basically what was happening, and this is an example of a systemic problem, is there were existing approval limits were causing a spike in the 0s and the 7s. What do I mean by that? There were inherent limits, approval limits in an organization at the $2,500 range and at the $10,000 range, which means a lot of the supervisors and the general foremans were purposely generating or asking the vendors to generate invoices in the 2,400 range and in the 9,000 range. When you apply taxes to those numbers, it generates $2,700 and $10,000. So that's why the 7 and the 0 were showing up higher than expected. So this is an example of systemic, right? The people aren't profiting from these manipulations, but they're manipulating the system to say, well, rather than putting the actual value of this PO or this invoice, I'm going to bring it down. I'm going to ask my vendor to send me 2 invoices of $2,400 instead of the actual price of $4,000 or $5,000. That allows me to sign for it. So the analysis we did for the client was, in terms of a summary, we were able to spot that we had approval limits for planners and superintendents and manager. And the problem was at that first level. The planners and superintendents were purposely, I mean, it is purpose, they were purposely manipulating the system by encouraging a lot of their vendors to stay within their limits. Okay. And this is an example of one of the questions just came up a few minutes ago, is where sometimes certain numbers tend to show up more often than others. But in this case, it came up artificial because it had to do with the company's approval limits. So an approval limit of 2,500 meant that when you stay below 25 and you add the sales tax of the province, you were generating more, exactly, a lot of samples, a lot of invoices, a lot of POs in that 2,700 range. So the 7 number shows up a lot. The last part here is you're able to take one step further. If you're really doing this in terms of the spirit of forensic analysis, we were able to see, well, which vendors specifically are falling victim, taking advantage of the system, right? So there was a total of 5 vendors that were primarily generating this high incidence of zeros, and 10 vendors that were generating this sevens. So we were able to have conversations with that total of 15 vendors to understand what was going on, fix the system on both ends, fix it from the supplier side, but also fix it from the system side through an investigation. There are other models. For example, the last 2 digits is a different model. This one is it's very similar to the one you saw about rolling a die. You expect the last 2 digits, the cents, to be even, to be flat. You wouldn't expect any gradual degradation from 00 to 99. Okay? Same thing happens here. There were 3 numbers that showed up a lot, the 0, the 50, and the 01. Now, without getting into all the details, the 00 and the 50 seems intuitive. Sure, it's possible that I price something that is a round number that $14.00 or $14.50. But the 01 had one vendor that showed up with a lot of 0.01s. So again, a very quick investigation was done on this one. It was not anything fraudulent or anything bizarre, but it allowed us to investigate that one vendor that was creating this section with high 01s. There's another one, the last 2 digits for the dollars. You can do. I think what you get the idea of here is there's distributions for almost anything that you want to look at in terms of your money example. So here you have the last 2 digits of your dollars. Again, you would expect this to be flat, to be even, but same thing happened. The 00 and the 87 showed up quite a bit, a lot more than expected. Same idea, the 00, fairly common. I wouldn't expect that to be anything weird or anything bizarre, but the 87 was bizarre. So it showed up in this example with this client 549 times with an 87 at the end of it, and it wasn't always the same product. It was just different types of products would end with 87. And you can compare it with expected outcomes. In this case, we would expect that number to be closer to 300. Why is it so high? You're able to investigate which vendor is causing this and do a little bit of investigation. And in this case, there was something a little weird going on, nothing too critical, too major, but there was something that was investigated and corrected both from the client side and from the supplier side because of this analysis. All right, so as a little bit of a wrap up, one of the things that probably a lot of you are thinking is, oh, that's all very nice. There's a lot of cute little statistics and graphs, but does it really work? Are you able to catch a fraudulent activity? The answer is yes, right? So the first thing I can say is, can the system be cheated? Of course, anything can be cheated. So the answer I'm giving as a general answer is maybe systems can be cheated, but it is very difficult for someone to purposely cheat a system. Just because there are so many ways you can investigate. I can investigate before the decimal, after the decimal, single digits, double digits. So there's many ways of actually attacking the data to see if there's anything bizarre happening. There's a lot of different tools, a lot of different distributions and models in your arsenal, basically. The other reason why it's difficult, in case people are interested in this topic, is humans have a difficulty creating random data. We always think we're good at it so that we're able to cheat the system. But there's a lot of really good games and a lot of websites that help you play around with this. We inherently have difficulty creating random data. So an example here, just as a mental exercise, if I told you I was to roll one die or a couple of dice, whatever the case may be, and I say I'm going to roll it 3 times. I roll it once, I get a 2. I roll it a second time, I get a 5. And if I don't give any context, right, without any context, and I ask 100 people, what is the next number that will be rolled? Almost no one picks the number 5, right? If I rolled a 2, a 5, they're going to say, oh, 3, a 1, a 6. So intuitively, we're kind of afraid to pick the same number again, even though randomly, the number 5 could show up a couple more times in a row. But humans are not very good at that, right? We tend to underestimate and overestimate the variation with numbers as opposed to what the statistic would tell us is expected. All right, so I'm looking at the clock. We're right on schedule. The idea here is, if you look at it as a big picture, data analysis is really all about converting data into information, right? And this is a very, very classic example especially when you look at things like invoices, POs, financial information, stock transactions. There's usually so much data. There's many streams and rows and columns, if you think of it, of data. So there's a lot of things we can look at and convert it to information. You can use it to detect fraud or even people purposely bypassing the system. Okay? So the idea here is, sorry, somebody asked a question or somebody's on the phone. Okay, thank you. You can detect fraud in this presentation. You saw a couple of different examples, one that was purposely done and a couple of them which were more systemic, where supervisors and foremen were purposely going around their system in order to be able to approve their invoices. And yeah, there's the important here, or the importance, of course, is to try and understand how to use what we often call applied statistics. It's not about the pure statistics. It's about understanding how to apply these tools and approaches to the right problem. And obviously, one of the things we offer at Analyze Improve is this aspect of using practical tools in order to analyze data and provide insights to potential issues. So I will open this up to a few questions, and at the same time, I will launch a quick poll to get a bit of feedback from the group. If you will indulge me, here it is. I've launched it. So, any other questions that I can field in terms of some of the things we covered? Going once, going twice. Okay, that's good. Thank you again for joining me. I think a lot of you are repeat attendees, so we record these. We'll eventually have them saved in some portal or YouTube channel so that you can go back and see it. And more importantly, if you do have any questions or you wish to have a little discussion on this topic or any topic, just go out and send myself or one of our colleagues an email. Thank you very much, everyone. Enjoy the rest of your day.